Hey, how's it going, everyone? This is mentfx, and this is episode 11 of the masterclass at 100 subscribers, which is amazing. Let's get right into it. So, for this video, we are going to specifically focus on risk management, one of the biggest parts of your trading strategy that a lot of people forget to really teach you about and explain to you about, and just expect you to kind of take whatever strategy it is that you learn and trade it successfully. Okay, without recognizing that, as we've discussed in some of our previous videos, risk management ultimately comes down to one of the biggest things that's going to be important in your entire trading career. As if you flip a coin and have proper risk management, you can make money. So imagine when you partner that with something like institutional analysis, institutional order flow, and understanding how to trade institutionally. If you've seen my last two videos uploaded yesterday on the 1st of November, where we did a top-down analysis of USD CAD and Euro CAD, you'll notice we had two perfect entries. We were looking at Euro CAD to come up into this area and sell off, and we were looking for it to also potentially come up into this area and sell off. We did get that sell off from this area with that Sunday open, grabbing all this liquidity, coming to mitigate at about half this order block, just where our entry was, and dropping heavily, looking to most likely create a little bit more liquidity as we move down to drop further down, taking out these equal lows we were talking about during our analysis yesterday. USD CAD just as well, anticipating that open, move up to this red line and that drop. And as you probably saw, we had this huge move up just like we did on the other, mitigating out of the positions in this order block right here, having our stop loss just above half of this right here, understanding that if price was to go up to this area or so, we'd actually be in a reaccumulation, anticipating higher prices. Instead, we were correct in our analysis. Our equal lows got finally taken just now. We came to that mitigation, creating a little bit of liquidity before dropping right through it, creating another order block, and just very clean structure at the moment in the version of a buy to sell program as well, looking to sell there. Okay, so using the analysis that we conducted on the 1st of November and seeing as how it's playing out, as well as some of the analysis that we've looked at in prior videos, we are going to frame and explain to you how you should be approaching risk management, how you should be approaching the management of your trades, how you should be looking to grow your account. Okay, so before we start with this, the amount of money in your account does not matter, okay? If you can grow it with $100, you can grow it with $1,000, you can grow it with 100,000, you can grow it with $1 million. That is not the important part about trading. The important part about trading is understanding how you're going to manage your risk no matter how much money you have. If you have 10 peanuts, I expect you to be able to bet these peanuts on this market and get me 30 peanuts down the line in the future, right? The idea is risk management will stay solid throughout this entire system, whether you're a millionaire or whether you're a thousandaire. Okay, so let's get started. The most important thing, as everybody always teaches you, is to trade with under, I believe, 5% of your balance per trade, looking to often take trades of about 1% or 2%. Okay, so these are very good guidelines. Of course, get your notebook out. And we're going to basically start off with explaining that risk management will also come from your personality, the way you enjoy to trade, your strategy, okay? The most important part about it is that once you have decided on one of them or demoed it long enough or even seen your strategy occur in nature over and over again and you're ready to take it to the live markets, understanding what type of positions you can get into and what type of RR you can get, the percentage you choose to trade should often not change. The only time it can change is maybe if your strategy evolves around something being a more riskier or less risky setup. But often, and at least in my mind, if you have a strategy that you follow and employ, and you have areas that you like to enter, and you like to see certain things before you enter, your percentage risk on that trade should always be the same anytime that trade presents itself. Instead of, potentially losing a trade and saying, oh, I should have risked less percentage, and maybe winning a huge trade and saying, damn, if I risked 1%, I would have made, 10% on that one trade. I don't think that's how you should ever go about trading risk management. Instead, you need to decide on whether you're okay with a 1% risk and growing yourself from there, or if you're okay with a 2% risk and growing yourself from there, or if you take very few trades, but you notice that they're doing very well, 3%, potentially even 3.5%, based on type of trader you are. I myself enjoy 1% that I just stepped up from 0.5%. So before I got into understanding everything that I was doing and anticipating things in the market, I'll trade 0.5% of my balance on each trade that I ever found. So this trade right here, 0.5%. This trade right here that I'm looking to set up, 0.5%. EuroCAD, the one we analyzed yesterday, this trade right here, 0.5%. Despite what the trade might be doing, the percentage risk is always going to be the same, okay? So now we're going to get into the idea of how you should be managing your trades in terms of your risk management strategy altogether, okay? There's two main ways you can manage a trade or be a trader. Of course, you want to keep your overall risk, let's just call that OR. Your overall risk should be less than or equal to 5%. I don't think you should ever be trading 5% or 4% of your balance every time you take a trade unless you have tried and tested a strategy that you have gotten down potentially as a positional trader, looking at very, very large long-term moves in the market. However, like I said, I don't think you should ever be trading that much. I think you should be keeping it under this number right here, equal to around that number. So what we're going to do is we're just going to make this 3%, recognizing that even as an intraday or positional trader, I believe that at max you should be risking about 3% on your trades overall. Okay, now there are two types of trade management that you can ultimately study and employ. Okay, they have multiple variations, but the two main types is an aggressive trade management style. So you have this aggressive nature, or you have this I don't know how to label it, but okay to take on more risk for future potential gain. So I don't have an exact word for this, but you have your wow, this is a little bit sad right here. Let's just get rid of that real quick. You guys did not see me misspell aggressive. So you have your aggressive traders and you have your traders that are let's call them sacrificial. You're sacrificing some potential gains that you can have in the short term to have very long term. Okay, these are your two types of trade management styles that you can have. Now, how does this ultimately work? Okay, there's multiple ways that you can trade within these two ways, right? The one way on aggressive, and this is the way I've seen a lot of traders employ, is to choose a risk to reward you will always take profit at, move stop loss to break even after certain amount of pips have moved in the direction of your trade. Okay, and what I mean by this is, if we just expand this a little bit, move this over just like that. Okay, so you have your two ways of managing a trade, which is your aggressive way and your sacrificial way. Now, when we're talking about managing a trade aggressively, what we're saying is that anytime you have a setup, whether the setup looks like it's going to continue all the way down here, or looks like it might continue to here, you will always decide on a 1 to X amount of risk to reward. So your risk to reward every time you trade is going to be, let's say, 1 to 5%, or 1 to 5. Okay, so what that means is wherever your stop loss is placed, whether it's here or a little bit higher, you're going to wait until your reward is 5 times your stop loss, right? So on TradingView, it's very easy to see it. As you can see, we're risking 16 pips to make 81 pips. And this right here, 4.99, is a 1 to 5 risk. And what I mean by this is that once you're tapped in, whether, like you see right here, price continues to drop heavily, you don't care. You are taking your profit at a certain area. Your setup is always going to be the same. Your strategy is to spot the setup, to get into the setup, and to sit in it until you get 1 to 5, 1 to 3, 1 to 2, 1 to 6, 1 to 7, whatever it is that you desire. Okay? If you are someone who has noticed yourself finding these areas and finding good entries on them on a 1 minute or 3 minute chart, then you could be someone that goes and scalps very small entries and gets 1 to 2, 1 to 3, 1 to 4 every single time on your scalps. or even 1-to-1. The idea is you want to decide your aggressive RR and you stick to that RR. You decide on this thing, you decide on 1-to-4, and you stick to that forever. And the second part of that is the moving the stop loss break even after a certain amount of pips is you have to set yourself a given number too. So seeing that you're on an hour and we're on just a normal currency, not something like gold that has crazy pip movements, you'll notice that it generally moves normally for a currency concerning pip wise. So what you could have preset is to tell yourself that break even will occur at 20 pips. Okay, so the way you'd be looking at yourself as a trader, if you're an aggressive trade management trader, is you're going to determine your 1-to-5 risk, always recognizing that you're going to be looking at taking profit at 1-to-5 no matter what price does. Even if price comes down to 1-to-4 and then reverses taking you out, you don't care because you have decided that you're going to be aggressively 1-to-5 every single time. On top of that, you're going to recognize that your break even will always be after 20 pips of movement. So what that means is that when this price right here, so keep this area right here in mind. This is the pip, the 7.7. After this market moved 20 pips just like that, your stop loss now becomes this area right here, thereby being break even. So what that means is that if price comes back up and hits this area, then you are out of the trade at break even, as if you've never even taken the trade before. Okay, the reason that we do something like this and why it is counted as aggressive, because even though you might have been correct about this move, the fact that it came back out to maybe re-mitigate an order block or something of that sort took you out of the trade at a time where you probably didn't even take the trade anymore because at this point you got broke even out of it. However, if it continued, then you would have caught, in this case, which you would have, this 1-to-5 relatively easy, which ended up being 80 pips lower, right? And this happened within just a few hours, as you can see. We had that Sunday open. We had 1, 2, 3, 4, 5, 6, about 8, 9, about 11 hours, 12 hours for this entire move to happen, okay? So that's your one way of doing it. That's one of the aggressive ways of trading, right? So take this down. If this fits your personality, this is what you want to employ. You select a risk to reward that you're always going to follow based on a certain thing that based on a certain setup that you see in the charts. You're always going to be entering on that, looking to grab a 1-to-5, 1-to-3, 1-to-2, maybe if you're on a lower time frame, 1-to-1, based on what you like to trade, how you like to trade, and how you've noticed that your setup likes to play out. By that same token, you have a break even set at a certain number of pips, which you again have seen happen in the past. Of course, you're writing it down most likely in a journal, noticing what gets hit and what doesn't, and setting your stop loss at break even after a certain amount of pips are in your favor, thereby negating that trade if it's lost and winning 5% or more based on how much you're risking on your trades after, okay? So that's one of your aggressive ways. The other aggressive way to trade, okay, and this is going to be almost tied between the sacrificial way and the aggressive way, is to put two trades onto a setup. So what I mean by this is you are still going to choose one of these numbers, right? So consider this for a second. You can make an Excel sheet to notice this if you'd like to, but the idea is, let's say you're just trading this way, and every time you trade, you're risking 1%. What that means is every time you win one of your trades, you'll be making 5% on your account, and every time you lose, you'll be losing 1%, right? So by that same token, you'd have to lose 5 trades in a row just to break even. And you'd have to win 4 out of 5 trades to basically make money in the long run, right? And you just do this over and over again, and that's all you ever focus on, okay? But the thing is, you're still only risking a certain percentage every single time. By that same token, the other way of trading is to also determine a percentage. However, when you determine that percentage, whatever it is to trade, so let's take a note on this. You determine the percentage of balance you want to trade, right? And after you determine the percentage of the balance you want to trade, what you're going to do is you're going to split that in half and enter 2 positions with that same percentage risk, right? So all you're doing is you're entering 2.5% position trades if you're trading the 1%, right? So what I mean by that is if you're trading 1%, for this strategy right here, what you're doing is you're opening two positions at 0.5%, both of them, okay? And what you're going to do is you're going to, here's your subsection, you're going to close the first position at a desired amount of RR, the same type that you would have chosen in this one, you would choose for this one. So always at, let's say, 1 to 3, right? Or 1 to 5. So let's just say 1 to 5 for the sake of this argument right here. Close the first position at 1 to 5. And then aggressively, hence being an aggressive trade management style, aggressively move a trailing stop loss of the second position. Okay, so let's extend this out a little bit. Let's put it right here. Let's just give this a gray color because it just comes right under that. Let's do this real quick, and this will be the subsection of that. So make sure you're taking notes on all this, because one of these is going to end up the way, is ultimately going to be the way that you trade in the market and how you make a living for yourself and how you start to make money trading, okay? So these are the two aggressive ways. What you're doing is you're either deciding on a RR, this 1 to 5, with a break even after a certain amount of pips, and you're always trading that no matter what, looking to either lose 1%, negate your position completely, or make 5% no matter what. The other way is to determine that same percentage that you're going to risk, but splitting that into two trades, okay? So what I mean by that is, let's get rid of that for a second and imagine this trade right here. Okay, so let's just replay this for the sake of argument. Yesterday, as you all remember, we were looking at entering at this area on EuroCAD. If you do not remember that, this was on 11.1. That's the top-down analysis for that. You can go and take a look at that. It's one of the prior videos just before this one. I thought it'd be a perfect time to release this because this is how I would be risk managing this trade, and that's how I was risk managing this trade. So what we'll do is we'll go up to here, recognizing that this was going to be our entry. Now, the aggressive way would be entering this with your 1 to 5, preemptively decided, looking to take profit here, move to break even after what point? When we reach 20 pips, and just take this 5%. The other way, right, and this is why we'll explain in a second why it's important, is to take two positions like this. And instead of each position being 1%, each position is going to be 0.5%, okay? So what's going to happen is you're going to have a 0.5% position here. This is 0.5 position here, and you're gonna have a 0.5 position right here, okay? These are both 0.5% positions. Now, as price comes up here, you get tapped into both of these trades, right? Keep that in mind. We're still in this trade and we're in this trade now. Now, as price begins to move down, your first take profit of your 0.5% position is taken right here, okay? So concerning the aggressive, whoops. Oh wow, that is embarrassing. Let's forget that we ever did this right here. And we'll just do that real quick. And none of you saw anything here. Okay. So, concerning being an aggressive trader, if you were the first variant, you would have made 5% on this trade guaranteed. Okay. This is your plus 5%, and that's it. Your bounce has just made 5% on it, and you're done, okay? Now, right, because you hit the 5% at 1% risk. But now we're looking at the other variant of it, the aggressive with the stop loss with two trades open. So what's happening is the second variant is to open a 0.5% here and a 0.5% here. Now, at this point, what has happened? Well, you're now guaranteed your 2.5% on this trade. Right? Because what happens is you risk 0.5%. So 0.5 times 5 is a 2.5% that you made. So now you've made 2.5% less in this trade. But now what we can do is we can start to move this stop loss aggressively, right? So we're saying that we're going to move it basically every time we create new lows, right? This can be based on structure. This can be based on an indicator that you have on your chart. This can be based on a type of candle pattern that you like to see. It can be based on a number of things. The idea is you want to create a thing that you understand, that you will consistently follow. So in this case, we're going to use structure, right? So we just broken structure. The new high is here. So what we're going to do is we're going to lock in this trade right here, right? At 1-to-1, so about 1%. So what we're doing right now, ultimately, is we are locking in. So if we just reopen this right here, 2.5% on this trade guaranteed, right? That's done. That's with the first position. And then the next position that's open is now guaranteeing us what? 1%. So we have a total of 3.5% guaranteed on this trade. However, what you'll notice is that's still under this 5%. So if we still traded the first variant, it'd be better in this case thus far, right? So let's just keep that in mind. And now watch as price plays out. So we're managing aggressively, remember that. So we break down hard. We're going to manage just to over this high right here, right? We broke right here. This is that main high. Now we've locked in 1 to 3. So let's just make it 1 to 3 to make it easy right now. We've locked in 1 to 3. What does that mean? That means our 1.5, this 0.5 position still has 2.5% on this guaranteed, right? We've already taken this profit. This 0.5 position, though, has now gotten to what? We've gotten to 0.5 times 3. So we've made 1.5% on it. So now we are guaranteed to have 4% on this trade, right? So this trade has guaranteed us 4%, which is still under this 5%. So notice the first variant of the aggressive nature of being able to trade is still better here. So what are we going to do? Well, we're going to keep on following our rules. We keep breaking, but we don't care yet, okay? We make this up move, break below, close. So now we can mitigate up to this position right here. Notice that. So now we've locked in 1 to 5.7 on this second trade. With this one already guaranteed, and this one now guaranteed 1 to 5. What does that mean for us? Well, that's 0.5 times 5.7, right? So let's just make it 5 for the sake of argument. So we've locked in 2.5%. So now we've actually guaranteed ourselves 5% on this trade. However, we can now go even lower potentially to make even more. Okay, so let's see what happens. So we have 5% guaranteed on the second variant of trading. Let's see what happens. Okay, so that's where we are right now. And what you'll notice is we made this small little up move, continuation down. What we could do is since we're aggressively mitigating this trade and letting it follow, is we can move it up to here now. Locking in 1 to 7.35, right? Thereby locking in a guaranteed 3.67%, right? So overall, if we add that to our original guaranteed 2.5, we have now locked in a guaranteed 6.175% on this trade guaranteed using variant 2 versus 5% guaranteed using variant 1. Okay, but what you'll notice and what's interesting now is that if price continues to break now, right, as we were anticipating price to go lower than all these equal lows here too, well then this trail will continue to trail until maybe, let's say, it gets stopped out right about here after we take out these lows and then continue higher. Now we've locked in 1 to 11 on this 0.5% position, right? So what's happened is we've actually locked in an extra 5.5% on that original trade, locking us in at 8% total on this trade. Right now it's at 6.17, so let's just leave it at that. But we could lock in 8% versus 5, right? Locking in almost double, or not double, but locking in a lot more percentage than we could have locked in using variant 1. And the cool thing about this is if we do break down and start to really change up structure and start taking out lows, well, guess what? This aggressive mitigation can continue to be trailed until we get a crazy risk to reward, right? So what we're doing is we're almost playing the sacrificial game, but we're doing it aggressively. So even if price moves up, it's okay. We get stopped out at a pretty big risk reward. But the beautiful thing about this second variant as well is that, let's say back here when we mitigated up to this area right here, price, instead of continuing lower here, just did this. Well, guess what? When we locked in this 1 to 5, and then we moved this down to where I believe it was right here or right here. Let's just say we moved it down to here. If price instead just reversed at this area and hit this right here instead of falling significantly lower, right, as it did here, then what happens is we still make just under 5%, but we understand that we had the ability to potentially make much more RR on this trade, especially if it continues, right? So that's one of your, spelled right this time. This is your two aggressive ways of making your trade. And one is, of course, choosing that RR, breaking even after a certain amount. And the other one is taking half-half and just entering it like this, right? With half being taken off at a certain point and half being taken off at another. Now, what's interesting is we can expand this into 3 or 4 or even 5 different ways of trading. So instead of going 50-50, right, you could start going 70-30, right? If you're more of a scalper and you start noticing that your trades ultimately always kind of reverse once they hit 1 to 5, 1 to 3, 1 to 2, whatever it might be, then what you could do is you can take 70% of profits off at that first take profit and let 30% run, because there's a chance that this 30% can become worth more than 70% or like 150% of your trade, right? So even if you took 70% off here and then let the rest of the 30% continue running, you'll notice that that 30% on 1 to 9 can make you almost equivalent to what you made on that 70%, right? And by that same token, if you start noticing that some trades don't, like more trades end up reversing after your first take profit gets hit, well, then you can up that to 90-10, right? The idea, though, for the second thing is that you always have a position that's going to run, right? And you're managing it aggressively anyway. So the idea is you're going to still lock in most of that profit, and then you have a chance of making that profit significantly bigger, right? Because say, for instance, you let that 10% run just because why not, right? You have your strategy, you know 90% of the time or whatever, it's going to reverse, but you're going to take off 90% of your position anyway. Let's say that 10% is met with some kind of information or news that comes out the next day that moves the market drastically. Well, if it moves the market drastically against you, then you've lost the 10% of that position, and it doesn't really matter because you've locked in this 90%. Plus, you'll be locking in a little bit with your aggressive movement of the stop loss. On the other hand, though, if that news is in favor of the direction of your trade, and that news makes the market drop or tank about 3 times or 4 times more than it did for this 90%, well, then this 10% that you left on your trade can be worth more than the profit you made from this 90%, right? So that's something that's very important to understand and consider as you decide whether you want to be an aggressive trader in the full sense that you choose an RR and get out with 100% of your position, or whether you split that up into multiple positions and end up taking it. And of course, splitting it up into multiple positions is not hard, right? Let's say you're trading Euro USD and you're trading, maybe let's say you have a smaller account and you have, let's say, $10,000. You're going to be trading, let's say, 1% of that, $100 on, let's say you're going to be trading $100 on each trade, and your trade is about 30 pips, right? Then you know your lot size is going to be what? It's going to be that divided by 10. So this is going to be your lot size, okay? And all you have to do now is, if you've decided to trade, let's say 70-30, all you're going to do is you're going to open one trade worth 0.23 lots, which you're going to close at 1 to 5, all right? And the other trade, you're going to open at 0.1 lots and just let it run, right? And the cool thing is, as we go on, this will increase exponentially, right? Because that $10,000 where you're only risking $100 per trade will become $100,000 where you're risking $1,000 a trade, which become $500,000 where you're risking $5,000 a trade, and so on and so forth. And your small risk and your small little disbursement of 70-30 or whatever it is can become huge in the grand scheme of things, right? Especially if you're with a prop firm and you're quickly building up your reputation with them, making more percentages, getting your account doubled, whichever prop firm it is that you end up going with, okay? Now, the sacrificial aspect of it is honestly just this right here with a movement of your trailing stop that's significantly slower. And also, it's more so of this without the movement of your break even. So of course, I prefer either this or this right here. If I miss a trade, it's unfortunate. The reason we call this sacrificial is because you're sacrificing some of your balance, right? If your stop loss gets hit, then it's unfortunate and you lose, let's say 1%. But because you understand your strategy and the fact that you maybe believe that price can come to mitigate a certain order block multiple times before dropping heavily, or you've looked at some kind of Wyckoff distribution and you recognize that we might need to mitigate and liquidate a position multiple times before we drop through it, then you could be a trader who ends up, you're either you're doing the same thing here. You're choosing an RR, okay, that you always take profit at, but you are not moving your break even until significantly lower. So it's just a little bit different than this, but you're ultimately just going to kind of hold. Honestly, understanding that your strategy, maybe let's say 70, 80% or 90% of the time is correct, even with your stop loss not moved. So you don't move your stop loss because you've recognized a lot of the times that if you, for instance, saw some kind of order block here and you saw price travel back up to it, mitigate it on a lower time frame, you enter that, move to break even, and then you get stopped out, but then it continues, then maybe your strategy is to enter off this order block and leave your stop loss up here or up here, recognizing that price is going to come back up maybe a few times to re-mitigate that area just a few more times, right? Mitigating, even mitigates a little bit higher than it, maybe taking out some highs, then drops. Well, now you've locked in all of this, understanding that your strategy is going to have sometimes some drawdown, right? And this can be very good for some positional trades specifically as well. Now, the second way is just this with a less aggressive trailing of the stop, or at least an understanding of when you should be aggressively trading the stop, right? So same as on the left, you're determining a percentage, you're taking it at 80-20, at 50-50, at 40-60, whatever it might be. You're taking that trade and you're entering it on two positions. Okay, but the difference is the second position that you're going to let run will be trailed much more slowly. Okay, so the point of this is that the reason this one right here is important, so my two favorite ones ultimately, I think you can trade either one of these, is going to be this one right here and this one right here, right? So let's just give them a little bit of a, so let's recognize that 1% is the star. Okay, usually that's what you want to go with. 2% is okay too. We'll give it a little bit of a thing. 3%, just ignore that. This is the star to use if you're aggressive. Of course, this can work very well, especially if it works with your strategy and you've seen it determined to be good that way, and it's something that you spot in the market, continues to occur with higher R. That's what you want to take. On the same reason, this one's very good too, because of the potential that you can make for sacrificing a little bit of the stuff in the short term, right? So for instance, let's take a look at this trade again. Now, if we are correct about this analysis, right, and we know price is going to continue dropping below all this, there's a chance that in the aggressive nature of moving the stop loss from here to then here, that price will just move to take out your stop loss here and then continue significantly lower to those potential interesting areas before we come higher, right? This is all extra space that you could have used to earn money, okay? But because you aggressively moved this stop loss, right? So you moved your stop loss aggressively from here to here to here to here, and now maybe even to here, just waiting. You've locked in a lot, right? But you've also sacrificed potential future gains by taking yourself out here. If you understand institutional order flow and you know where the price is most likely going to go and it's going to continue going down, let's say under all these equal lows that we had institutionally analyzed yesterday, then what you're going to do is you're going to move your stop loss a lot slower, right? It's going to be a much, it's not going to be safer specifically, it's going to be more wide. So what I mean by that is you might even be on a higher time frame, like let's say a 3 hour, looking for that structure. So right now, your actual area of, so your first take profit got hit, but your second one would still be, for instance, here, right? Until you saw a 4 hour break that continued maybe lower than all of this, you wouldn't be moving this. So this will still only be locked in at 1 to 1.5, right? But what this will do in some cases is set you up for very, very, very large moves in the future, right? I've seen some clients get about 1 to 80 with this way of moving your stop loss. The idea is it won't be, in this case, it's kind of a bad example, but the idea is that if you get in off a 15-minute, okay, and on a 15-minute, you can be aggressive, moving your stop loss from here to here, right, to here, as we keep going lower, to here, whoops, ignore that, to here, which might have gone almost stopped out there, till right here, right? So far, this 15 would be very nice with the aggressive moves, right? Now, the reason we like the other one is because sometimes what we'll see is we'll see fake breakouts. Why? Before this continue lower. Because we're trying to grab liquidity and create liquidity and mitigate areas of order blocks, right? So the idea is if you were aggressive, you'd get out here and you're locked in and you've made a lot of profit. But other times, by trying to move your stop loss aggressively, you might get stopped out way earlier before price continues lower. So by that metric, you'd want to be on a higher time frame, even off of a lower time frame entry, moving your stop loss to those areas off a higher time frame. Understanding that price can switch structure and move within a 15-minute up and down scenario while still being in a higher time frame directional bias. Okay, so for that reason, you want to decide which one is better for you, and of course with some back testing, with demo testing, and with analyzing the markets daily, looking at what's happening in them, you'll be able to decide whether you like the idea of trading aggressively, trading with a given RR every time because you don't like to wait and have to move your stop loss over and over, right? It all comes down to you. But generally, you have the roadmap right here. You want to choose a percentage, keep it under 3%, decide on it. Choose whether you want to have an RR, and you continuously take your profit there with a break even that you move at a certain amount of pips, or that you don't if you're maybe on a much lower time frame looking to scalp and you understand that prices can come back to those areas a few times before hitting an RR. Or determine the type of percentages that you want to split a trade up between, and take some at a given RR and take the other with a trail. And this way, once you've locked that in, you'll be unstoppable in the sense that you will understand why your account is growing, how to grow your account, and compounding will not become an issue to you because you understand exactly what you have to do over and over again, whether you have a $100 account, a $1,000 account, or significantly more. And this will allow you to sign up with prop firms and not have to worry because you understand what you're doing, okay? So I hope you took a lot of notes on this. I hope this makes sense. If you have any questions concerning trade management or risk management, please ask me below. Risk management is one of the biggest parts of your strategy, as I've talked about on this channel before. I hope this video pretty much cements everything concerning risk management and how you want to manage your trades. And I hope this helps you guys become successful. So thank you for watching. Till next time.